Let's take another caller right now. John in Richmond Hill, go ahead.
And good evening to both of you. A question to David about Manulife. It's a time to buy now or hold it, and if you want it or not, because my understanding is it pays about 4% now.
Right.
Okay.
So, John, I think, Manulife has been under a little bit of pressure over the last few weeks after a pretty nice rally off the lows in February. One of the concerns for the sector, the life insurance sector, is what's going on with interest rates. And when you consider that there's $10 trillion or more of sovereign debt that now pays a negative yield, a lot of the returns the insurance companies get to meet their obligations come from buying and holding sovereign debt. And so when interest rates are very low, it makes it hard for them to generate the kind of return they need to generate to meet their obligations. So I think that there is a general concern in the life insurance community that if rates were to stay low for a long time, it could turn into a problem. They all smooth their returns or average out the kind of yields they get over time. But if it stayed low long enough, that could be a problem. Manulife as a company is doing a great job in growing in multiple markets. But I think that right now it's being negatively impacted by sort of a little cloud over the insurance group. And frankly, over financials in general, banks, regional banks in the U.S., asset managers all having some difficulty. So in the short run, I think that there's some risk. Longer run, I think as a business, a great business, it's just a question as to whether we get some kind of a turn in rates or flattening out at some point. And I think you can't bet on that right now. It looks to us as though yields are still headed lower.
So if you,
it's going to be a headwind for a while.
If you own it, though, and you have some patience and you're getting a bit of a dividend here, stick with it?
Yeah, I think that it depends on your time frame. I would prefer to go to something that I know will benefit in the current environment. So I would prefer to own a dividend payer that has a very stable cash flow, maybe one of the consumer staples companies, maybe a more quickly growing utility that actually benefits in this environment.
Okay, let's take another caller right now. Alex in BC, go ahead.
Oh, hello. I would like to know if you know what will happen when DuPont and Dow merge. What will happen to the stock price and shares, etc.
Okay. So, generally when you put two of these big businesses together, there's going to be plenty of opportunity to cut costs, and so there's going to be synergies. We think that ultimately it's probably going to be a pretty good deal for the shareholders. The history on these things is that you're going to have an opportunity to make some money. We own some Dow Chemical. We don't own the DuPont. I think you could own either.
Okay. Let's take another caller right now. David in Hamilton, go ahead. David, are you there? I think so. Okay, David in Hamilton is asking about Medtronic, I believe. So what do you think of the company, the medical equipment group, and whether or not this is the one to own? So
when we look at leadership in the market, as it stands right now in the U.S. market, healthcare, technology, industrials, all good groups. We really like healthcare, and specifically within healthcare, the best sector right now is medical devices. So Medtronic is a company that we own. They are big on implants, both for hard implants, minimally invasive implants, and also for spinal implants. So we have an aging population. A lot of replacement parts are required.
Right.
And Medtronic is doing a great job. They're growing very nicely. They're growing their dividend very nicely. This is a 1.8% yield. It's in a neighborhood that is seeing new cash get put to work. And it is unlikely there's going to be any challenge to the funding for devices going forward. So it's a growing addressable market.
David, it
We like
seems
the stock.
you like the stock and you own the stock. Okay. It seems though historically that when you take a look at the medical device companies like the Boston Scientifics, the Medtronic, Strykers of the world, that historically, if the economy was in fact rolling over, these stocks do not do well. They follow the economy because people need money, obviously, to get their hips and knees replaced. And in the States in particular, there's not a lot of funding for that, depending on your insurer, your company's insurer. So these stocks historically haven't done well. However, I'm wondering though, because you do definitely see money flow go into it. You'd see that more than I would from your trading
Yes.
desk. But I'm wondering if people aren't just piling into the Medtronics of the world because there's not many other places to go in healthcare because of all the concerns regarding drug pricing. Are you seeing that?
I think that there's some fair comment in that, but at the end of the day, it's a secularly multi-year growing market.
Okay.
And they are growing their market share within that market very profitably. So actually, insurance coverage is expanding in this area. And frankly, we really like the U.S. domestic economy, and this company is pretty focused in the U.S. domestic economy. So it's not just Medtronic. I mean, Boston Scientific's doing well. Edwards Lifesciences is doing very well. This is a very clear leadership space in the U.S. market currently.
Okay. We're going to be back after the short break. Past picks are coming up next.